Hey, good afternoon, everybody, to session 3 of our 201. So today we're going to be talking a lot about housing programs, resources, and have a lot of opportunity to ask questions. Everyone is encouraged. We've got the chat, or you can raise your hand as we're going through presentations. And today my co-host is Kayla Savage with the Community Development Division Director for Department of Commerce. Trish is on the road, so thank you, Kayla, for jumping in to help today on this. So we've got a great lineup today, and a lot to cover. So we're gonna jump in and hear first from Tylen Dyer. He is the Chief Development Officer for Petra and has been in land development space for over 20 years with experience in planning, engineering, construction, and operations. Tylen has a passion for helping and enjoys getting the right parties together to create successful projects. So I really appreciate him joining us today. I know we were talking a few weeks ago, and it's like, man, this is stuff I think a lot of communities out there would really like to hear. So thank you for agreeing to share your insights, and we will turn it over to you and let you get us kicked off.
Awesome. Thank you for that intro. Clearly I wrote it because there's a lot of good stuff in there. So thanks for saying that. Yeah, like she said, we're a private company. I'm going to give you a quick overview on Petra. I'll go ahead and share my screen so you can see that. I thought I already had, but I didn't. So here it is. And we'll just kind of run through this. These things are always awkward. I'd much rather be in person with everybody, but we'll get through this just fine. This is some of our contact information here that may come in handy for some people here in a little while. But we'll go ahead and just jump in. So Petra, we were established in 2016. As you said, we have a passion for helping. We want to help people succeed through real estate, just essentially through investing with real estate. So we started with that in mind, just being a small company, trying to help individuals that were on the smaller scale instead of the ultra rich invest in real estate, which is actually easier to do than what most people think you can do. But doing that, we've now started to grow, and we've grown into a multifaceted real estate investing platform. So we have a wealth of knowledge and experience on our team. We've got about 25 employees right now, and it just continues to seem to grow every day. And then we work really hard to deliver superior quality. So we really want to make that happen. We know that that's going to continue to drive our growth and future expansion. So in that little deal, just a quick overview, we provide real estate investment through a couple funds and through syndicated deals. If you don't know what those are or anything, I'm always happy to answer questions at any point. But we manage a lot of facilities, both our own and then for other people as well. And we do real estate brokerage. Most people know what that is: buy, sell, lease, kind of how that works. We also do mortgage brokerage, which is something that most people don't understand that is available, but instead just call on your banker. It's not always the best answer. We like to get a competitive system put together and get it out on the market and make sure that a lot of people are seeing it. And sometimes the best solutions aren't just a bank. So we can help in a lot of those situations as well. We place capital, which is another thing. We have a lot of connections to folks all over the country and internationally that are wanting to put capital into deals depending on what they look like. And then of course we do land up development. So land up development is something that is probably going to get a lot more focus today, simply because we're talking about housing and the need for housing in our wonderful state and how we attack that. So that land development goes the entire gamut from light industrial to general commercial to all the way to multifamily. So, and I kind of talk fast, so I'll leave a lot of time for questions at the end. But we were asked what our difference really is. So we like to partner. We love to partner with individuals. We love to partner with organizations. When I say organizations, we're talking about schools. Talking about when I say schools, higher education that have land that need to be developed. We partner with cities. We're right in the middle of a couple of those right now. Other LLCs, so organizations that are investors, we like to partner with them something that wealthy landowners usually don't want, is a big check. It creates a lot of headache for them. They have to pay a lot of taxes on capital gains. They have to reinvest it. So what we do is we partner with them and bring them in our fold, and we help them see what their dreams are and help them get to that solution, I guess, is what we do there. So next, we're going to talk a little bit about the housing perspective from our side. Everybody on here has probably read 1,000 different, I guess, reports or data or whatever you're seeing, wherever you get your information. And we hear that the housing situation is brutal in Kansas. I will tell you, in the last 2 months, I've had at least 50 conversations with folks throughout the state of Kansas, and I'm just here to tell everybody what they already know, that indeed it is real. No matter what you read or anything, it is real all the way to the lowest side and all the way to the highest side. It's a crazy real problem we're having, and something we've really never experienced. So we're trying to get our hands around it. Indeed, to go with that, it is multifaceted. It's not just one portion, it's across the board. So this is what's really weird to us. You can go into any community. They need starter homes, they need apartments, they need second homes, they need kind of retirement homes where you're looking for slab on grade, no stairs. And there's just a lot of need across the entire board. And so from a development standpoint, that's a lot more attractive than just saying we have one issue, because then we can go fill a lot of different needs and figure out what we can do there. The other thing that we're finding in this is that it's changing quickly. As most of you are hearing, we're getting a lot of drive of population from the West Coast that's coming to the Midwest very, very quickly. And like I said, you guys, I don't mean to tell you something you already know. Everybody's probably already plenty intelligent on this. I just want to reiterate. So it is changing quickly, because every day we're seeing another company announce that they're going to hire more people. They're doing that when we're already way behind the curve on this. There's not housing anywhere, and we're just not getting it done fast enough. So we're trying to go as fast as we can to help the fact that it's changing quickly and we got to catch up. So the other part, and I kind of mentioned this, how it's multifaceted, it's changing quickly, but it's not easily quantified. We've seen third-party reports, we've seen data reports, we've seen all of that comes out to tell us that there is a need, and everybody will focus on what they like to focus on, whether it's multifamily, whether it's single family, it doesn't really matter. They're telling us that there's a need, but I haven't seen it well qualified. So we have some issues at a lot of our smaller locations throughout the state. And I guess I'd like to clarify something. When I say rural, I don't mean to insult anyone. Anything outside of Wichita, Kansas City is considered rural. In our world, it is what it is. But that's but every one of those locations is trying to quantify their need. And if you go into a city of 20,000 people that hasn't really built anything new besides onesie twosies for the last 30 plus years, it's really hard to quantify what the need actually is. I mean, you can quantify the travelers, quantify the jobs, you can quantify a lot of things, but we really don't know how many units have to be built. So that's a hard thing for most people to get their head around. But the reason why I bring that up for everybody's knowledge is when you can't quantify something, it's really hard to get investment dollars or capital placed or anybody to back the job. So to make all of this worse, this is exactly why we're in this space, because the large developers are not willing to come to rural America and make this happen. So my business partner and I, my business partner grew up in a little bitty town just west of Garden City, and it's Holcomb. I say little bitty, but he laughs at me because it's bigger than the one I grew up in. I grew up in the Oklahoma Panhandle in a little town a little speck that nobody knows. So we're both small town guys, and so we've built this company to help, and we want to go help rural communities. And so that's really important to us, and that's why we're going to these locations. So you may feel like you have a need for 1,000 units. We'll probably come in and talk about more like 100 units and figure out how to get there, just to start that spark, right? To be the spark for the community and show what that is. Because frankly, we don't know the impact and how much impact 200 units in a 20,000 unit or 20,000 person town will really, or what that impact will really be. And that does concern us, right? We do not want to hurt community. We want to definitely help. And so that's why I say it's not easily quantified, and it's really hard to get the big investment dollars to follow us. So we spend most of our time doing that, is trying to make sure that the project can go and make that happen. Let's see. So the next deal. So to kind of talk real quick about what we're looking for in projects. I know this is probably important. Some people don't really know what we do, how we do it, or anything like that. And there's probably some people on here that probably know it better than I do, which is awesome. So if you have feedback, I'd love to hear that as well. But so what we're seeking in projects is we have kind of quantified what we believe on the top end are the two most important things. So community support. When I say community support, I'm talking like local government, economic development leaders, the Chamber of Commerce, high net worth fans is what we call them, because they're cheering for the community. There's a lot of high net worth people out there that want to put their money somewhere else, and they're not really a fan of the town or the city or the local community they're in. Frankly, we don't really care about them. We want to work with people who are fans of the community we're working in. If we don't have the support of those folks, then it's just not going to work out well. And then, of course, all business owners, smaller business, small, big, anything like that. We want them completely involved in this process. In fact, you'll see this later on, but we ask to be connected to all of them. I want to have those conversations way up in front. We want to make sure that that's happening. The second really big deal that's important to us is quantifying what the economic growth could look like. Of course, a lot of that is from existing companies, from companies that be coming to town, from what you see drives value in your community. That's what we have to understand. The sell part for us to go get more and more dollars tied into the community, we have to have these two really, really well defined. If we step outside of that, we can look at the additional items. The reason why I say they're additional, they're kind of more in the weeds. Some of them are on the finance side, some of them more on the development side, but we really, of course, have to dig in on what the incentive packages are. So I would ask everyone, if you're looking at doing something like this, to be open. You need to understand that the incentive packages are going to be different. We understand that, but we're also going to ask for a pretty comprehensive incentive package, and we're going to try to access anything we can to help make it more feasible to build in a smaller community. Ease of development, that's another item that it's harder to come to a location where you don't know everything like we do in some of the larger locations where we are. So we need to know where the available land is, right? Who we're going to have to go through to get to the land, who we're going to have to partner with. Can we get it annexed? Is the platting process, can we expedite that? Or is it going to take us 120 days to get anything done? So the ease of development is a very, very important. Of course, utility locations, floodplains, all of that fun stuff that we have to deal with is very important for us to understand. Of course, and then trying to define the need. Like I mentioned earlier, third-party studies are awesome. They are phenomenal. In fact, you can get some of them done for pretty reasonable. You can also spend a lot of money and get a really, really thick book on it. We're looking for some basic information, and I'm happy to talk about that with whomever, but we really like to see number of jobs created, other jobs are going to be created, the number of people that are traveling that would much rather stay at home or live where they work as opposed to driving back and forth. So defining that need is really, really important to us. So the next deal. So to kind of, like I said, I want to go for about 15 or 20 minutes and open it back up and maybe stay ahead of the schedule or help everyone else out. But to get our attention, to kind of play on the word, the grassroots rally, that's really, really important to us. As I said, we look at every project separately. We digest it. We make sure that we can either help it be a success or help someone else come in and make it a success. So the grassroots deal is we have to invest and get every one of our hardworking people, the ones that are driving our economy every day, we have to get them engaged. And when I say that, I want the managers, I want everybody at these companies to feel their pain. And when they feel their pain enough, then we can start telling everyone about it, right? It just can't be the CEO of a company saying, I need 10 jobs. We need to hear it from the community. And I like to go get engaged. I like to go fill up with gas or go to the coffee station or coffee shop and just talk to different people and hear what's going on in the community. So we definitely want to make it a rally from the ground up. The reporting side, like I said, the third-party studies are amazing and they help us. But data doesn't always have to come from there. I mean, it can come from any of these companies that you have in your communities and other needs that are driving this growth. And then preparation, like I said, we want to know the ease of development. We know what's available, who the owners are, ease of transaction or willingness to participate, location of utilities. And then the other part of this is existing rental rates. I haven't talked a lot about that, and I probably could go back and spend just a little bit of time on it. But unfortunately, in our smaller locations, rental rates have not been accelerated yet. And so we are going to see that. If you guys haven't seen it yet in your location, you're starting to see employers bump all their pay to $20 an hour. That's kind of the number we're seeing. And they are driving a whole lot more growth with that. They're getting a lot more attention with that. Unfortunately, higher wages, inflation, all this fun stuff drives higher rates, interest rates and everything, but it also drives higher rental rates. And so when I'm trying to finance something and get everything pushed through with the dollars, I have to make sure that the rental rates are at market value, and market value sometimes has to be a little higher than what it is existing, especially when you're putting new units on the market. So sometimes that is kind of gets in the middle there. The other big deal that we love, and we've had success with this, is just general connections. So when we come to town, we want to make sure that we're able to talk to everyone. So business leaders, anybody who is a voice in the community, we love to talk to. We like to have open houses. We like to go sit down. We'll rent out a building and just talk to a bunch of people and just feel what their pain is and what the real need is. And that tells us quite a bit on that end. So that, and then once again, we love to be connected to any of the high net worth fans, the folks that can really, really help push these projects forward. So I stayed just under 20 minutes, I think, or maybe in there, but there's some more of my contact information there, but really, I think that was about it for me. So we can have questions or anything that we want to go through at this time.
Thank you very much for sharing that. I know it's kind of the thing with any type of project, it's always getting that piece of the what is it that we need to be doing and where should we be concentrating. We think we know, but to hear from someone who is on that end of a project is definitely helpful. So thank you on that. And we don't have any questions yet. So I think I'm going to go ahead and kick this over to Randy and Kayla so they can talk about the developer list. So we can kind of see what they're doing across the state to bring communities and developers and projects together. So if
go ahead, Kayla.
Randy, if you want to.
Yeah, go ahead. Ladies first, Kayla.
I think Randy, you were up with developer list first, but I will talk about the HAT, the housing assessment tool. So Randy and I are both with the Kansas Department of Commerce, and Randy can introduce himself, but I'm the Community Development Division Director here and work with the programs like CDBG that specifically focuses on housing rehabilitation. And we've had several communities across the state that have successfully utilized that grant program through the years that really focuses in on those homes that have exceeded their useful life. And so those properties would be candidates then for demolition, but then pair that with funding for rehab of homes that just need a little shot in the arm to get their properties safe again. So Randy, do you want to go ahead and introduce yourself, and then I can talk about the HAT? You're on mute.
Thank you, Kayla. Yes, I've got a background in real estate development, developed in 10 states. I was then I was the undersecretary of the Kansas Department of Commerce when housing and commerce were together. Then I went to the city of Topeka, deputy city manager there, and the key economic development contact. So I've been on both sides of the fence, and I really enjoyed some of the things that Tylen brought out. They're exactly right on, and some of the ways that we're going to have to create some disciplines in order to solve these issues. So anyway, Kayla, you want to go ahead and talk about the hat, then I'll mention a
Yeah.
couple items.
Perfect. All right. I'm going to go ahead and share my screen. So there's a major resource here that Commerce provides, or we house the website essentially. So this is effectively supposed to be all of the housing resources that are available in the state of Kansas. And so this is really meant to be a one-stop shop, but we also recognize that if there's something out there that we have not listed here, please reach out and let us know. But these are mainly focused on the resources that are available to communities, either through the state or USDA rural development. And so that's also from Kansas Housing Resources Corporation, USDA, Rural Development, Federal Home Loan Bank, and then Commerce. So there's some featured resources that we have right at the top. One of our new programs that Randy manages, the Shovel program, and then the housing developer database that he's going to talk about here in just a minute. And then the one that I wanted to mention, of course, was the housing assessment tool. So while Tylen talked about, the data, how important that data is to collect so that we can make sure that we know what the need is in a community for housing. We know that the need is great, but sometimes a community doesn't always know exactly where to start or what particular kind of housing is their greatest need. And so really we developed the housing tool some years ago, actually. The Housing Interagency Committee that includes those partners that I just mentioned, meant to be a tool that communities could really kind of work on themselves, that they would not necessarily need to hire a professional consulting firm, but definitely not something, it's not something that's frowned upon to do that. It's just that we wanted to create something that would put it in the hands of the community that they could go ahead and do themselves. And so that's where we came up with the housing assessment tool, or HAT. We do love our acronyms in state government, and it's even better when they actually spell something. So this is what it looks like. It's meant to be a very straightforward tool that talks about the needs and how a community can walk through that. And let me see if I'm sharing my screen here. Can you see the HAT tool still? Yes. Okay, great. So it's very user-friendly. We just ask you to go through, make sure your stakeholders are at the table. I don't remember the term that Tylen used, but maybe these are the folks that are the really important ones that are going to be investing potentially in housing, and public-private agencies, and then also other stakeholders. We want you to take a look at your regional area. And what's really awesome about this is the state housing assessment that the Office of Rural Prosperity and Kansas Housing Resources Corporation partnered together to put out just last year, or the beginning of this year. We're looking to that tool so that communities can look at their regional area and reference that in the HAT. So I'm going to just quickly go through here because you don't need a HAT 101, but we do also ask about, jobs created, business, for businesses. What's the economic development value here? And what impact does that have on the housing stock? We know that it has impact, but we're asking for actual numbers and data here. So these are the top 5 businesses that we ask that data about. And then there's some demographic questions that we ask about as well. If any communities need any assistance with the census information, please reach out to our office. We're glad to help there too. And then the housing characteristics, this really gets into your housing stock. And so this is really, a lot of people have asked, what's the best way to do this? You can do a driving tour or, a questionnaire also to your residents. And then we ask about what have you done in the last 5 years? Basically looking at community capacity when it comes to resolving housing. And just some other questions. Part 4 is probably the most important part. What is the data telling you? So analyzing that data, and Is there a change happening with employers, economic development projects? Has your school seen a huge increase? Has it seen a decrease? Again, what are those needs? Are there employers that are going to come to the table and be part of that solution? And this seems like an insignificant part when you look at, oh, it's just one box, but I want to encourage communities to take some time to really think about that and analyze that data. And I will say too, that this analyzing the data is really key to the next stepping stone for if you want to pursue a rural housing incentive district as well. So it's really, the HAT's a great stepping stone if you haven't done any, looking at housing data or studying that. This is a great spot to start. So with that, Randy, if you want to talk about the developer profile, I'd be happy to show that part of the site while I've got my screen shared, if that would be helpful.
Sure.
Okay.
Knowledge is power, and people can't cooperate with each other and get a common goal unless they know who each other is. Real simple. So we created a developer profile, which I'm glad to say Tylen's company is listed on there. And we've got about 50 some companies that are listed. And what we're working on, it's still a work in progress because we're adding some additional filters for it, but it lists the various developers and what they prefer to do, what type of activities, and also where they will go build and develop. So it's feel free to look at that and go through it. And if you know other developers that are not listed on it, they can sign up right here on the web page. So also something now of something new. Part of my role is to work, first of all, with businesses, especially those that are saying they are having some housing challenges associated with their workers, but also to work with the communities and the development community. So part of the issues that comes about is understanding some of the jargon that people in their specific fields. So there will be coming up shortly a calculator for a home ownership project and a duplex project that I've prepared as a spreadsheet, basically showing people who may not be involved in this business on a day-to-day basis what some of the issues are and how the different layering can take place with the various subsidies and some of the things that the developers work on. Because if you want to really be an effective partner, you're going to have to understand some of the issues and some of the terminology that is used. So anyway, real simple. My email is randy.speaker@ks.gov. That's randy.speaker@ks.gov. If you'd like to see one of those, like I said, I've got one I've done for a duplex project and one for a single family home. The other issue that we're talking about to a lot of the communities is to go talk to the lead business people, because we have the Kansas Housing Investor Tax Credit, which is a very unique, a lot of states have a state version that goes with the LIHTC, but not very many have this particular resource. And it's going to be a tremendous resource. But the idea is, what we're not wanting to see happen is we don't want to see it get devalued, the price of these credits. So we're wanting to have the communities talk with the businesses when they have an idea of a housing project, and we can maybe bring them together with the developer and get the tax credits pre-sold at a high price, so that it's a benefit to all. So anyway, that's one of the efforts we're going to be working with here in the near future as that unfolds. So with that, I would just go ahead and open it up if there's any questions. If not, I'll hang on here for future questions.
Thank you for that information. And still not seeing any questions. So if anybody has any, please feel free. Now's your chance. You've got a lot of people in front of you right now that can probably answer a lot of questions that we've been wondering. But so just at any time. So Now we'll transition over and hear about setting up RHIDs, rural housing incentive districts. And that was something in Grassroots 101 had communities wondering, how do you do this? And really, what are the details and specifics about the program? So brought some folks in that deal with this on quite a regular basis. So we'll start with Garth with Gilmore Bell, has practiced law and municipal bond attorney since entering the practice in 2006. He's a member of the Kansas Bar Association and the Wichita Bar Association. Garth received his BA in political science from Pittsburgh State in 2002 and his Juris Doctorate from the University of Kansas School of Law in 2006. And with him also going to be Dominic Eck, shareholder with Gilmore Bell and at the Wichita's office. Dominic has practiced in the area of public finance since joining the firm in 2015. Is a member of the Kansas Bar Association and the Wichita Bar Association. Has earned his BBA in accounting cum laude from the University of Notre Dame in 2006 and his Juris Doctorate from Washburn University in 2012. So definitely some knowledgeable gentlemen here to present about the RHID, and I will turn that over to you so you can share your presentation.
Okay.
Thank you.
Yes, thank you very much for that introduction, and also thanks to Kayla and Randy for kind of the intro and the good transition over to us. It's pretty helpful, kind of having that lead in to talk about rural housing incentive districts. Before we get started, as was mentioned, my name is Garth Herman. I've got Dominic Eck here with me. We work out of the Wichita office of the law firm of Gilmore and Bell. As some of you may know, but some of you may not, we specialize in public finance, and especially out of our Wichita office, we work with communities all over the state of Kansas. Both large and small, on different types of projects and different types of financings in order to help them improve their community and to make their communities a better place. One of the places that has been really hot in that area for the last couple of years is housing, and in different ways to provide incentives and to encourage housing in Kansas, both in larger as well as the more rural communities. And one of the areas that we've really done a lot of work on is with the use of these rural housing incentive districts throughout the state of Kansas. So what we plan to do here is go over the RHID Act itself and kind of give you the nuts and bolts breakdown of what it is and how it works. And then, kind of get into a little bit more of the detail on the back end of it about, specifically what does that increment mean and how does the RHID actually pay for anything. And so with that being said, I'm going to turn this over to Dominic Eck to lead us through the first half of that. And he's going to share a screen and a PowerPoint to kind of help us walk through this.
Thanks, Garth. Get this screen shared here. All right. So as Garth said, I'm Dominic with Gilmore and Bell, and one of the first questions with an RHID, one of the basic questions is who can create these? Who is eligible to use these tools? And the answer to that question has been changing over the last few legislative sessions. So as of now, any city with a population under 60,000, any county with a population under 80,000, also the city of Topeka, all three of those categories qualify as an eligible city or county that can create an RHID. Additionally, if there is a city that does not otherwise meet that population threshold, but has a qualified census tract as designated by the Housing and Urban Development Department, if that city wants to create an RHID for projects within that qualified census tract, that may also be an option. That's a new change just with this last legislative session. So the last session has opened it up to a couple of new categories. Previously, There had been some other, loosening of the strings as to which cities could or could not qualify based on removal of the county requirement for cities. But right now, that's where we stand. Cities less than 60, counties less than 80, city of Topeka, or projects within these qualified census tracts. Next question is, well, if we have an RHID, what can we spend the money on? Basically, the money can be used for infrastructure purposes, site acquisition costs, and not construction of horizontal vertical improvements. However, there are exceptions to that. If the project is located in a qualified census tract that we've just talked about, or if it's located in a central business district, and the structures in that qualified census tract or central business district are over 25 years old, and there's going to be a renovation that will primarily result in residential use, then the eligible costs are greatly expanded. And these RHID revenues can pay for vertical construction type costs and renovation costs. And so, as lawyers' favorite answer is, it depends. So what costs are eligible for RHID? It depends on what type of project it is. If it's a greenfield, brand new project, you're looking at infrastructure and acquisition costs. If it's a renovation project in a qualified area, then that expands the eligible list to some more vertical and building type costs, because in those cases, most of the infrastructure is already there. You're not going to have a lot of infrastructure cost that needs to come into play. It's a building that already exists. The street's likely already there. You might have to upgrade some of those services and utilities, but the main pieces of that site have already been put into play. And so the RHID can still help in those circumstances, just in a little bit different way. So if you are a city that can qualify, then how do we go about setting up the RHID? Well, the first step is a housing needs analysis. It ties in really well with the housing assessment tool that was just discussed in the previous presentation. With the housing needs analysis that the city performs, if it finds that there's a shortage of quality housing in the city, that shortage is expected to persist and is a deterrent to future growth, and that basically we're not going to get a lot of new development without some incentive and action on the part of the governing body, that's the first step. You take that housing needs analysis, the governing body adopts a resolution making certain findings, those findings that we just discussed, that, hey, we don't have enough housing, and we've got to step in here to help. You identify an area of the city or multiple areas of the city that the governing body wants to focus on, or the county, I should say, that the governing body wants to focus on, and you send that resolution making those findings along with the identification of the targeted property areas, and along with that housing needs analysis up to the Kansas Department of Commerce for approval. And the Kansas Department of Commerce will have the ability then to either agree with those findings or to disagree with those findings. Assuming the Commerce Secretary agrees with the findings and says, yes, we agree, all of that information you provided shows a shortage and that we need an RHID or some other incentives to help stimulate housing development, then you can move on to the next step. And the next step is the development of a plan, basically a development plan. And in that process, what you're going to look at is, again, you're going to identify the specific district location and map. And this is, at this level, you have a actual project in mind. There's a developer that has come to the city or county has identified and is working with, and they say, yes, we want to do this type of project in this location. Great. Let's identify that. on the map. Let's identify it with a legal description. We need to get together the current existing assessed valuation for that property. We need the owners of all the land within that area. And we need a description of what you're planning to do. Tell us, kind of the general plan. Are you building 100 houses? Are you building 15 duplexes? What is it that you're looking to develop on this property? And then you take a estimate of what the eligible RHID expenses will be. You estimate what that new development will create in terms of RHID revenues, and you have a little feasibility analysis to see how well those match up and whether the RHID, along with other sources of revenue provided by the developer, are sufficient to pay those eligible costs. After the development of this plan, the governing body will adopt a resolution to call a public hearing on this plan. The public hearing, there are notice and mailing requirements. At 30 to 70 days later, the governing body holds the public hearing. After the public hearing, if they so choose, the governing body at that point can then pass an ordinance to establish an RHID district in that jurisdiction. So that's kind of a quick and dirty of the basic steps. It's basically number one, are you an eligible city or county that can create an RHID? If you are, number two, do you have your housing needs analysis that shows that there is a need in the city that requires intervention? It requires an incentive package to help stimulate development. Number three, send that up, get approval of the Department of Commerce. Number four, you identify a specific project in a specific area and have a description of what is going to be built on what property. Number five, you're going to call for a public hearing. And then number six, you're going to hold a public hearing and then consider an ordinance to actually establish the district. So one of the big questions, though, that we haven't yet discussed, that Garth will, is we talked about what can you use the money on, but the big question is where does the money come from? And that's the increment piece, and we'll let Garth go through that with you.
Thanks, Dom. And before I jump to that, I'm going to go back to the second slide really quick. A couple of practical things to keep in mind for cities or counties that are looking to create one or more rural housing incentive districts. Once you have that housing needs analysis in place, you can then handle that next step, which is basically designating your eligible areas and receiving approval from the Commerce Secretary. You can handle that step in a couple different ways. One way you can do that is just on a project by project basis. So you have your housing needs analysis in place, and then you can wait until a developer comes to you and says, we have a specific project, for this property. And we would like for you to declare that or designate that property as an eligible area and to have the Commerce Secretary approve it and then move on to those steps that Dom talked about, where you have the resolution, calling the public hearing, holding the public hearing, and then passing that ordinance. So a city or a county, they can handle that on a project by project basis, with each individual district getting approved by the Commerce Secretary as an eligible area. The other way that it can be handled is if the city or the county want to make a designation up front that there are, multiple areas within the city or multiple areas within the county that they would like to have designated as, eligible areas where a future district could be created. You can do that also. So for instance, let's say you have 10 areas within town that you would like to have designated as an eligible area. Once you have your housing needs analysis done and you adopt that resolution that makes the findings, you can include the property descriptions for all 10 of those areas. And in essence, then the Commerce Secretary, if they approve that resolution and that finding of the needs, then they would have approved basically all 10 of those legally described properties as eligible areas. And what that means then is in the future, then when that developer comes up and says, I have this project that I would like to have a rural housing incentive district for, and it's in one of those 10 areas, it's already in essence been pre-approved, then you're ready to go. And then you can start off with that resolution to call the public hearing that Dominic talked about. So there's a couple different ways that it can handle it. And frankly, we've seen it handled in both ways, both on a project by project basis, as well as on a basis where there are multiple properties that are already described as eligible areas. So that's just kind of something to keep in mind as you're looking through these initial steps and how best to handle those for your city or for your county. So now moving forward to, how does the RHID actually work? The basis for the RHID is it is a incremental type of project financing. And what it does is it, in essence, takes incremental property taxes that are realized by the increased value of the property within that district. It takes those incremental property tax revenues and it diverts them to a special RHID fund that is held by either the city, if the district's created by the city, or by a county if the district's created by the county. But it diverts those incremental property taxes into that special fund. And then those incremental taxes are what are used to either pay for or reimburse the costs of those eligible project expenses that Dominic talked about. Now, when we talk about the increment of the property tax revenue, that does not mean that it is all of the property taxes that come from that property where the district is created at. So for instance, the state of Kansas levies 1.5 mils. That 1.5 mil levy of the state is not diverted into the RHID revenue stream. Likewise, there's a 20 mil school district levy. That 20 mils is not diverted into their RHID revenue stream. There's a little bit of a difference here between an RHID and a tax increment financing district as it relates to the capital outlay mill levy for the local school districts. The capital outlay mill levy for RHIDs are included in that revenue stream. So that means that for capital outlay mill levies, that revenue stream is diverted into the RHID revenue, and unlike TIF, where it is handled differently. A couple more things to keep in mind is that this diversion of the incremental property taxes, it applies to all of the taxing districts that levy property taxes upon the property that's within the district. So it's the county, it's the school district, it's the city. If there's a township levy or a cemetery levy or a watershed improvement district levy, whatever those types of mill levies are, those will all be diverted other than the 1.5 and the 20 that we previously talked about. The life of an RHID is for up to 25 years. And then that increment, that revenue stream that goes into that special fund, it can be used either on a pay-as-you-go basis, which means usually on a reimbursement basis. That is, the revenue comes in, then the city or the county can voucher it out and disperse it to pay for project costs that are eligible and which have already been paid. Or it can be used as a repayment stream for the issuance of special obligation RHID bonds. So the question usually comes up then is, okay, so that's what the increment is and that's what it can be used for, but realistically speaking, what is the increment and how do we get to that? So here's an example of kind of how that increment works. So if we have a piece of property, and let's say that right now its base value, its assessed valuation is $1,000. And so when that property is designated as a rural housing incentive district, so in Dominic's example, the public hearing is held, let's say it's a city project, and the city passes its ordinance that designates that property as a rural housing incentive district. When that ordinance is passed, that is when the base value of that property is set. So in my example, that ordinance is passed and the base value of that property is set, and it is $1,000. That is the assessed value of that property. So any taxes that are levied on that $1,000 property value, those taxes go to the taxing jurisdictions as if there was no RHID. So the school district still gets its, full amount of mill levy off of that $1,000 assessed valuation. The county does, the city does, the state does, whoever else levies property taxes on that base value, on that $1,000 of assessed value. Those property tax revenues go to those taxing entities as if there is no special district. Now, the theory is that as these RHIDs get developed and the houses get built out there, that valuation is going to increase. And so as that value increases, those same property tax mill levies are levied against that property. But the increased value is going to lead to increased property tax revenue. And that increased property tax revenue, that's the increment. So in my example, where originally the base value of that assessed valuation is $1,000, once the development is up and running, let's say the value of that property, the assessed value of that property, increases to $1 million. And assuming that the same mill levies are being charged against that property from all the local jurisdictions, then in essence, what you would have is your base value is still kicking off $100 in property tax revenue. That still goes to the school district, to the county, to the city. There's no changes there. The increased value, though, is then you're going to have a lot of additional property tax revenue that comes from that. So off of that increased valuation, the 20 mills that are levied for schools, in my example, that'd be $20,000. That still goes to the school. That's exempt from the RHID revenue stream. The 1.5 mills is levied by the state of Kansas. In my example, that'll be $1,500. That still goes to the state of Kansas. That is outside of the RHID revenue stream. All of the other property tax revenue from that increased valuation, in my example, that'll be $78,400. All of that property tax increment, that goes into the RHID fund. And that is the amount that is available in order to pay for the RHID's eligible costs. Once again, whether that's on a pay-as-you-go basis or if it's going to repay the RHID bonds. And that amount is in my example, is on an annual basis. So once again, RHIDs can go for up to 25 years. And so that $78,400 in my example, that's on an annual basis, and that could be for up to 25 years. Now, obviously, this is just an example, and there's no guarantee as to what that amount is going to be. And it can actually fluctuate even once the district is fully built out and up and running. That amount of the property tax increment is going to fluctuate because it's a function of the assessed valuation, and it's also a function of all of the separate mill levies that are being levied against that. So if the school district lowers its mill levy, if the county lowers its mill levy, if the city lowers its mill levy, then obviously that is going to have an effect on the amount of revenues that are available from that increment. So that's just kind of something to keep in mind, but basically that is how the increment works, where the base is always set and all of those entities remain harmless, and they still get the money basically after the creation of the district that they got before the creation of the district. And then once you back out the 20 mills for schools and the 1.5 mills for the state of Kansas, every other property tax dollar that's levied on that increased value, that goes to help pay for the cost of the RHID project. So the effect on the other taxing jurisdictions, once again, a couple things to keep in mind. Everybody is held harmless at that base property tax levy, just like I said. At the expiration of the RHID, so either 25 years or when all the project costs have been paid or repaid, then the total improved valuation goes back to all the taxing jurisdictions. So once the project is completed and paid off, or once the 25-year term is up, in essence, the district dissolves, and then all of that increased valuation and the property tax revenues that come from that, those flow back to all of the taxing jurisdictions. So they get the benefit of that. As Dom mentioned, a public hearing is required before a district can be created. And then there are also veto rights. So at the expiration of that public hearing and the passage of the ordinance, there is a 30-day veto period during which the school district, which levies property taxes on the property, or the county, which levies property taxes on the property, or if it's a county RHID, a city, if the district is within 3 miles of the city boundaries, any of those entities within 30 days can take affirmative action to adopt a resolution that finds that the creation of the district will have an adverse effect on them. And if an entity does that, then the district has been vetoed and it does not move forward. So another practical thing to keep in mind is when you're creating an RHID, in essence, you are asking the other taxing entities to forego property tax revenues in the future in order to help with this development. So it's always a good idea to have those conversations with the county and the school district if you're a city, and if you're a county doing it, obviously with the school district and with the cities as well, to make sure that they are aware of what the project is and what they're being asked to do, to make sure that you can make it through that veto period without any sort of ill effects, coming back on the project or on the district. So just a couple things to keep in mind there.
Yeah, so, this slide is kind of intended just to be a summary of what we discussed and kind of lay out the steps again. The other item to talk about here that we haven't previously mentioned is, though not necessarily statutorily required, we always recommend and include a development agreement between the establishing entity, whether it be a city or county, and the developer. And that's just going to lay out the obligations of the developer, obligations of the city, the expectations of what's going to get built on what timeline, and ensure that everybody kind of understands and is clear on the path of the project and how it will move forward and what will be the result. And so again, here's kind of a little quick and dirty cheat sheet for what you're going to need to do to develop an RHID project. As Garth mentioned, the first 3 bullet points may or may not include multiple project areas, multiple different land designations within a city or county. And so you may or may not be able to kind of fast forward through those 3 steps if they've been previously taken. But if you ever have any questions on that, how this works, how to set it up, you want to discuss a particular project or generally want to discuss, how can we be as ready as possible to implement this into our city, our county, please feel free to give Garth or I a call, shoot us an email at any time, and we'd be happy to discuss with you or take questions now if you have them now.
Yes, thank you very much. Yeah, that last part, that last 30 days, that ties right back to when Tyler was saying, have everybody at the table and have a lot of conversations before you go into these. So that fits really well. And we do have a couple of questions. And Carolyn, since you're on here, I'll let you go ahead and ask your question in reference to the tax strategies that you mentioned.
Well, probably everybody can see the question, but well, I'll get into this a little bit later when I talk about our project, but a lot of what has been driving what makes things feasible for us is just getting the cost of the project down in the first place. And I've worked with Dominic in the past on a commercial project in which we issued an IRB, not because it was the financing tool, but just because it was the avenue to avoid sales tax on the construction materials, which saved a lot on just developing the project in the first place. And so I'm interested to know if there is an angle that exists for IRBs on a residential project, if it is, developed in a commercial sense, or if there's some other mechanism besides an IRB that could save on that aspect of taxes.
That's a great question, Carolyn. And the answer is maybe. It depends. I know, I hate it. That's what our answer always is, but it is. If it is a project that is developed as a commercial project, in other words, the housing facilities are expected to be leased out in a commercial venture, then IRBs certainly could be available to pair with this and help make the project even more viable. Absolutely. If they are going to be owner occupied, single family housing, or even, owner occupied duplexes that each owner is going to just buy their own half. That's not considered a commercial activity at that point. And so IRBs cannot be paired with that type of project. But yes, that is certainly one of the things that it's one of the first questions we ask when we have these things going is, how do we anticipate the project being used? What other avenues might there be to help further enhance the project and its feasibility and the possibility for a good, successful housing increase for each town? So great question. You are absolutely on the right track. If trying to combine some of these things, it's a bit of a puzzle to see some can and can't fit together, but that's part of these pre-meetings that have been discussed, and why it's good to let's talk about them early and often, and make sure that we are utilizing all the tools in the toolkit to give the best success chance for the project going forward.
Thank you.
Thank you. And we have another question from Caleb. On the example for the increment, does the entire increment have to go strictly to the repayment of the project every year? Or can a percentage go back to the project and the remainder go back to other taxing jurisdictions?
Well, so that's a really good question. So once again, when I was talking about this, kind of the difference in some ways between the RHID and TIF, kind of the tax increment financing. TIF, it's very clear that the full 100% of that increment does not have to go to the repayment of the cost, that it can, basically be apportioned back on percentage basis. There's not that exact type of language in the RHID Act itself. We think that there are, depending on what the end result is that the city and the other local players are trying to get at. We always like to figure out, okay, where are you trying to get to? And then let's see how we can get you there. And so even if it is an example of, that the state law may not exactly authorize that sort of an arrangement. There are ways that we can still get the project, in a similar point, like I said, so that it can be what the city is looking for, what the school district is looking for, what the county is looking for. There are definitely ways to get to that point. Yes.
Thank you. And Tylen, while we still have you on, we had a question come in for you. Here I see. You may have had to take a call or something. But we'll make sure when we get Tylen back on, we'll get to your question, Leah. So for now, thank you for that presentation. And now we're going to move over to Kevin and Ty. Do we still have Ty on? Looks like we may. Oh, no, there you are.
Yeah.
Got to find the right boxes. Everybody's moving around. Get something in the chat. I had a comment here from Charles. In addition to the sales tax exemption, IRBs usually result in an abatement or a reduction in lieu of tax of property tax up to 10 years. Therefore, wouldn't using IRBs impair the RHID increment tax income's ability to cover eligible expenses incurred?
So it could. IRBs do not have to include a property tax abatement component. And so it is possible to issue an IRB solely for the sales tax exemption, leaving the full amount of property taxes still on the tax rolls and contributing to the RHID account. Alternatively, there could maybe be some other strategies in there where you try to combine both to again, look at the overall financial health of the project and see what's the best combination here. But specifically for that question, yes, if you exempted you're exactly right. If you exempt the property tax, then there's going to be nothing that's coming into the RHID fund. However, you can still get sales tax exemption without doing the property tax exemption and allow you to kind of get the get the best of both worlds there.
Very good questions coming in. Thank you. Okay, so now with Kevin Mcgowan, he's a shareholder with the Gilmore Bell Law Firm in Wichita. Kevin began practicing law in 1994 and is a member of the Wichita and Kansas Bar Associations. He received his BBA in 1990 from Washburn and his Juris Doctorate degree in 1994 from University of Kansas. While in law school, he was a member of the Kansas Law Review, associate editor of the Criminal Procedure Review, and a member of the Order of the COIF. I'm not sure how to say that. And then we have Ty Lasher. He's with the City of Bel Air. He spent his entire career in local government. Is a graduate of Mid-American Nazarene University with a bachelor's arts in agriculture and Wichita State with his master in public administration degree. Ty worked for the department head in Jefferson County for 5 years, Reno County for 10 years, and was city administrator in Cheney until 2007, when he accepted the city manager position in Bel Air. He has served on numerous boards and activities of organizations, both locally and nationally. So thank you, gentlemen, for joining us. And now we'll let you talk about land banks and how those are a benefit to a community.
Okay. Thank you. As others have said, very nice introduction. And for those of you wondering, I am just down the hall from Garth and Dom, so we're in the same place today. The way Ty and I thought we would break this out is I would maybe talk a little bit about kind of history and context of land banks, how they even came about, how you create one, what their powers are, and again, just give you a feel for what they can do, why you would think about them, and then transition to Ty talking about his experience in Bel Air, which has a very active land bank, probably about as active as any land bank that I have heard of. So I'll try to move quickly through my part because it's a lot drier than probably Ty's real world examples, and then hopefully have some time for questions at the end. So the history and context of land banks in Kansas really began in the late 1990s. The city of Junction City was preparing, and some of you may recall this, for a large influx of soldiers due to the proposed Big Red 1 buildup at Fort Riley. And developers flocked to Junction City to develop new homes and subdivisions. The city of Junction City financed and constructed public infrastructure to serve the new subdivisions. That troop expansion, the Big Red 1 returning to Fort Riley and the numbers that were expected, it didn't happen. So many of those developments failed. Developers went bankrupt, leaving the city with hundreds of vacant lots, associated infrastructure debt, tax, and special assessment delinquencies. Then not long after that, with the Great Recession and the associated housing market collapse in 2008, other cities in Kansas began having similar problems with underperforming housing developments, tax delinquencies, non-payment of special assessments. Land banks prior to that time were authorized by statute, but only for Wyandotte County, and that was as of 1996. So the legislature enacted new land bank legislation in 2009 to authorize city land banks, at least in part, we think, to respond to the problems created by the failed developments, tax delinquencies, distressed property that I referenced a moment ago. This discussion will focus on city land banks, but in 2010, the legislature acted and authorized beyond just Wyandotte County land banks for other counties as well, and they're empowered, and the creation process is very similar to what we'll talk about today with cities. So the statutory provisions that we're dealing with are found at KSA 12-5901 and the following statutes from that. And those provide that the governing body of any city in Kansas can establish a city land bank by simply passing an ordinance. And it's sort of fast forwarding, but the land bank could be dissolved eventually, again, by passage of a simple ordinance. The governance of the land bank is by a board of trustees. That board is appointed by the governing body of the creating city or county. Governing body members of the city may serve on that board. And Ty may talk about this a little bit, but you can have, say, a city council creating the land bank and then appointing itself or some of its members as the board of trustees for the land bank. And there are provisions in the statutes for filling vacancies and those sorts of things. Once created, the board of trustees selects from its membership a chairperson, vice chairperson, treasurer. The treasurer has to be bonded in such amount as the governing body of the city or county will determine appropriate. The folks serving as trustees for the land bank cannot receive compensation by statute, but they can be reimbursed for expenses in attending meetings, carrying out duties, etc. The board of trustees may appoint officers, agents, and employees to perform various duties and determine the qualifications and fix compensation. So there can be employees if the land bank is active enough. The land bank is subject to the provisions of the cash basis law, which, for those of you that don't know, applies to all Kansas cities and counties and basically requires that those entities can't incur financial commitments beyond the funds that it has on hand in the current budget. So you can't do deficit borrowing for operations is what that means. And all cities and counties are accustomed to that, and other taxing subdivisions as well. And land banks are also subject to that law. All monies of the land bank are treated as and must be invested as public monies. The board, like other governmental entities, must also deposit its monies in designated depositories, which usually have to be in the county or counties in which the land bank is situated. The land bank must prepare an annual budget. It's subject to open records, open meetings laws, must have its meetings within the creating city or county. The land bank is subject to conflict of interest and ethics laws, and the board and its member trustees are subject to and protected by the Kansas Tort Claims Act. So what I've just been describing hopefully gives you a feel for a land bank being just another form of local government entity. It's subject to all of the same laws that I just mentioned and restrictions and protections. It's just the land bank has very specialized powers as compared to other local government entities. And those powers are that the board and the land bank can sue and be sued, enter into contracts, appoint and remove staff, acquire by purchase, gift, or devise and convey real property. All of that's pretty standard stuff for local government entities. But the land bank can also acquire property from the city that created it, the county that the land bank is located in, including property that the county has acquired via tax sale, or any other city or taxing subdivision within that county. So again, the land bank can acquire property from any of those entities in those circumstances. And the transfer of this property to the land bank shall not be subject to any bidding requirement and will be exempt from any provision of any other law requiring a public sale. And there are laws like that in certain instances require a city or county, if it's disposing of property, to go through some sort of public bidding or public sale requirement. And so none of that applies if a city or county is transferring property to the land bank. The land bank may also sell any property that it's acquired without competitive bidding and upon whatever terms and conditions and subject to restrictions and covenants it deems necessary or appropriate. So again, a little different than other local government entities in that it can sell property not subject to any public sale or public bidding statute, and basically under whatever terms and conditions it deems appropriate to sort of effectively utilize or reutilize that property. If there are delinquent special assessments on the property that's being sold, and those special assessments were used to finance public improvements, the land bank does have to get approval of the governing body that levied those special assessments before it transfers that property. The land bank can rebate all or any portion of taxes on property sold or conveyed by it, exercise any other power which may be delegated to the bank by the governing body that created it, exercise incidental powers. So again, that's all just kind of getting back to, this is like any other governmental entity, except it has those specialized powers as it relates to acquiring and selling property. The Land Bank Board of Trustees may establish special advisory committees. And I think the idea behind that is if you have a particular neighborhood where the land bank has property, it can appoint that advisory committee to advise it. And then you have some folks on that advisory committee that are a little closer to that neighborhood and what the needs of that neighborhood may be. So I'm not sure if there are any of those out there. There isn't in Bel Air, but maybe in other places. So I referenced special assessments a little bit before. One of the key powers that a land bank has when it acquires property is that while the property is held by the land bank and until that property is sold or otherwise disposed of, the property shall be exempt from ad valorem taxes or payment of the ad valorem taxes. So there's a tolling of taxes on that property. And I referenced earlier, just distressed property. And this just gives an opportunity for the taxes to be tolled and until some determination is made as to what's the next best use for it. Special assessments levied to finance public improvements are not tolled, but there are special statutory provisions for those. Special assessments levied by a city or county to finance public improvements on property that the board acquired and is holding, the county treasurer shall automatically remove from the tax rolls those assessments, charges, and penalties at the time of acquisition. So that happens automatically. If there are special assessments that have been levied, the county treasurer will understand the land bank is now the owner of that property. And again, those are tolled for a period of time. The property held by the land bank shall remain liable for those special assessments, but again, no payment thereof is required until the property is sold or otherwise conveyed by the land bank. And a couple of newer things, and maybe we see this more often than anything else, that the governing body of the municipality that maybe levied the special assessments on the property that the land bank is holding may abate all or part of those special assessments by agreement with the land bank. And then those can remain off of the tax rolls if they're abated by the county treasurer as set forth in that agreement. So again, if special assessments are delinquent, land bank owns the property, they can enter into an agreement with the city that's levied those special assessments and agree that maybe those are abated for some period of time until the land bank has sold the property. And then the last thing I wanted to reference, and it's a 2015 change to the statute, and it relates to special assessments, is that the governing body that has levied special assessments on this distressed property that the land bank now holds may enter into an agreement to defer or re-amortize part or all of the special assessments. And that's different than just delaying them and then, picking up and they're fully subject to the special assessments. The governing body of the city that imposed the special assessments does have the ability to go back in and rework the specials, re-amortize, maybe if that's advantageous to reutilization of that property. So quick summary, again, distressed property, the land bank is probably typically going to hold, and maybe with tax delinquencies and in particular special assessment delinquencies, and the land bank has some powers and authority to delay those things and maybe work through reamortization or delay of special assessments in a way that makes the property attractive to the next purchaser and perhaps next developer of the property. So I will stop there and hand it off to Ty, and he can give you some real world flavor for how this has worked in Bel Air.
Thanks, Kevin. Shout out to Gilmore and Bell. Appreciate them being on the presentation today, but we also use them as bond counsel, and Kevin and I we probably talk once a week at least on a lot of different projects. And so they really know a lot about what's going on in the RHID, the land bank, et cetera, et cetera. So they're a great resource if you have questions. So I'm going to talk a little bit about the creation of ours, how it was set up, the funding, and then what we use ours for. As Kevin said, we're pretty active. I bet our land bank meets once a month, or at least once every other month, and have for the past several years. So our land bank was created in 2015, being an ordinance. Kevin outlined all the requirements to create the land bank. As he said, it allows parcels to come off the tax rolls. We saw that as an important piece because if you're part of it as an economic development tool, the land bank is, and if you're a city and you're holding land, you're paying property taxes on that. Those property taxes, part of it comes back to the city, but a lot of it goes to school districts and things like that. So this is the way that we saw to share in that economic development cost of owning land, was that the parcels would come off the tax rolls and the city wouldn't be funding other property tax or taxes, taxing entities. The other thing Kevin said was special assessments can be delayed. And that's really going to be kind of a marketing question. If you're owning land or lots and there's special assessments on them, there is a benefit because the city is responsible for those special assessments, or the land bank is responsible for those special assessments. We also know that the city is responsible for those bonds. So if the land bank doesn't pay the special assessments, then the city has to cover those bond payments. Now, the marketing piece is that if you're trying to sell that property or that lot, is there a benefit in pushing those special assessments out of additional years, or is it better just to continue paying the special assessments, and then when that parcel is sold, those people have less years of special assessments? So in our case, that's what we did. We continued, or the land bank continued to pay the special assessments. And then when we sold the parcel, there was a certain amount of time left on those special assessments. As far as our bylaws, the name that we created was City of Bel Air, Kansas Land Bank. That was pretty innovative, we thought, but probably should say your city somewhere in that. Again, Gilmore and Bell can help you come up with a name. The offices we identified as City Hall simply. Board of Trustees was created, and as Kevin mentioned, all of our governing body is the board. So and the terms run consecutively with their terms as city council members. We did appoint one non-voting member, which is the city manager, and then the officers, as Kevin mentioned, the chairman, who is the mayor, the vice chair, who is our council president, and the treasurer, who is a non-voting member, or the city manager. So, and then of course in the bylaws, there's meetings, quorum, compensation, everything that Kevin mentioned. Basically, as a government entity, those are all included in the bylaws. So the funding, It states that the governing body may advance operating funds to the bank to pay expenses of the Board of Trustees in the bank. So that's what the city of Bel Air does. We, in our situation, we own land. It started out in 2001 of 2,000 acres of land that we owned. And so there was bond payments that went along with that. And so the city simply budgets annually funds to go to the land bank to cover those expenses. The land bank, as Kevin mentioned, has to create a budget, and we do that and adopt that annually, and then it's published just like all the other political subdivisions. The bank makes an annual report, so that's something that we do at the end of the year. It simply identifies the amount of the land that's owned or parcels that are owned by the bank, the land bank. And then any disbursements and receipts that were received, in other words, whatever was sold and how much was made is also included in that. And then it also requires that an inventory be published in the official city newspaper on or before January 31st. So it tells what parcels that are owned by the land bank. And then it also states that monies that are collected through the sale of property shall be retained by the land bank. So when we sell property, it goes into the land bank fund. And again, the land bank is responsible for financing of that land that was purchased. So really our specific story was in as I mentioned earlier, in 2001, the city purchased roughly 2,000 acres. Again, it was for economic development, it was for annexation purposes, and it was for growth. If you're not familiar with Bel Air, we adjoin the city of Wichita, and they are on our south side. As you get close with other municipalities, you have annexation wars and growth wars, and that was a way that the city at that point said that they didn't want to be surrounded by another city, and so they took an aggressive step in actually purchasing and then annexing all that land. So again, the issue that we ran into is, even though it was raw land, the city was paying the taxes on all that property, and so that was one of the main benefits of creating the land bank. The land was actually purchased under the Public Building Commission and financed through the Public Building Commission. And again, Gilmore and Bell helped us in that creation, as well as the land bank. The Public Building Commission doesn't have the ability to waive those taxes, so that's why we created the land bank and basically transferred all that land from the Public Building Commission over to the land bank. So when we did that, so that the property would come off the tax rolls, obviously we had to create the land bank, we had to transfer the property over to the land bank, and then we had to send that information of the parcels and the documentation of creating the land bank to the county as well as the Board of Tax Appeals, so that those parcels would come off the tax rolls. And then once the properties are sold, then they automatically go back on the tax rolls because it's no longer the land bank that's owning it. The statute requires that the land bank hold one annual meeting. So as I said, we meet almost monthly, so we don't have any issues with that. But if you have a land bank that's not active, you need to hold at least one meeting. They're very similar to what the cities or counties would do, any government entity. We give at least 24 hours notice that we're going to hold the land bank meeting. We put out an agenda, and of course on the agenda we have the previous minutes, we have a section for public comment, then we have any actions that the board is going to take, and then if there's a need for executive sessions, we will hold that as well. And of course, there could be an instance where a business is looking at a property, and so you might need an executive session for those types of things. We did also approve where the chairman and the treasurer are allowed to sign documents approved by the trustees. as well as closing documents. So in other words, when you have the city council as the land bank board, if we would get a contract by someone that's wanting to buy a parcel or a lot, then we would take that to the land bank board, and they would approve or disapprove or request additional discussions, and ultimately, when they would approve the sale, then we would send that, as you would any kind of sale, to the title company, and then that would allow myself or the chairman to sign all the closing documents once the contract was approved. We did have a situation where we had a local developer that had a number of lots, went bankrupt. The bank took possession of those empty lots, and in part of the negotiations with that bank, they actually transferred those lots over to the city. So the city had residential lots, or the land bank had residential lots, and we also had raw ground as well that we were selling. Now we did, as the city, we did contract with a marketing company to sell our land. As Kevin said, you don't have to do that, but we did that to try to be able to get the land and the lots out to the surrounding people that might be interested in purchasing this, rather than just doing it ourselves. So worked very well. It's been very successful in Bel Air. Like Kevin said, I'm not sure of anybody that's used it as much as we have, but it was very successful adventure for us. So that's really all I had as far as our story. So if there's any questions for Kevin or I, we'd be happy to answer those.
Thank you very much. Go ahead, Kevin.
Carrie, I was going to add, for Bel Air, it's suburban and sort of heavy on new development. Maybe if you have a distressed new development, a land bank is a way that you can relieve some of that distress, and on a better day and a year or two, maybe have a different developer that can come in and make something work. But there is an opportunity, and I'm actually talking with a city now that has both some newly developed lots that they would like to have in a land bank, but also some of the downtown distressed properties that cities will frequently acquire through the dangerous and unsafe structures process, where somebody needs to have done certain things to shore up their building and they won't, and statutes provide that the city can then go make those improvements to shore up the building and then assess the cost, pass along the cost to the property owner. You have a lot of situations where the property owner says, I'm never going to pay those taxes. It's more than the building was worth. And so in those circumstances, sometimes before the city makes the improvements, the city will just buy the property and say, instead of us going through this process of giving you notice, having a hearing, making the improvements ourselves, condemning the property or putting on the tax rolls, they just buy it for some agreed upon sum. But they're thinking about, when they acquire properties in those ways, to put them in the land bank. And it's not going to be the special assessment delays and reamortization, but it does provide the opportunity, I think, if there's an interest in downtown redevelopment, that a land bank could be a tool, whether it's kind of multifamily. We're seeing more discussion even with RHID of apartment downtown areas, older areas. And so I did want to make that point. If you're thinking about and working on something where you think a land bank might be useful, because if they owned this, we'd have a delay in the payment of taxes, get things off the tax rolls, and that will help us negotiate with this new purchaser developer. It can apply to, again, sort of abandoned, older, distressed properties if you were thinking about redevelopment downtown.
That's good to know. Thank you for adding that. Yeah. don't see any questions. I did put in the chat that a document that outlines what Kevin has gone through, all his steps, as well as ties information will be shared. Presentations with the recording on the website. So if you didn't catch all of that in your notes, we'll have that posted for you. So now we'll move on. We've got Molly and Carolyn, and kind of like how Ty was able to talk about the how-tos, using these programs in communities just to kind of get best practices for just a variety of ideas. But we also reached out to Molly and Carolyn to talk about what they're doing in their communities and, you know, how it can be duplicated and adjusted to fit your community. And Molly is the Assistant Director for Economic Development at Dodge City Ford County Development Corporation. She's been working on addressing housing needs in Ford County since 2015. How time flies. And Carolyn Dunn is the founding executive director of Stafford County Economic Development, which started in 2011. Available housing has been a long time challenge in the county of 4,000 and was one of the first initiatives for the organization. Stafford Economic Development is engaged in remodeling new construction and incentives to individuals for construction. But the greatest activity has been all new construction. And I think we're going to start with Molly. You're going to share your screen, and I think she's going to show you how you can access and look at what she's got going on.
Hi, can everyone hear me?
Yes.
Okay. So I'm going to start just by showing you guys our website. If you go to dodgedev.org and click on housing, great information from Gilmore and Bell on the RHID. We've done lots of work with them. On our website, if you go to Rural Housing Incentive District, we actually have examples of the development plan that we use that you guys can copy from our website. So we use the RHID to help our developers, incentivize our developers to build market rate housing. We also have a nonprofit called the Community Housing Association of Dodge City, and it focuses on moderate income housing. So we apply for and use moderate income housing grants through the Kansas Housing Resource Corporation to start the abandoned housing program. I'm going to try to show a video. Let me know if you cannot hear the sound on this, please. CHAD, the Community Housing Association of Dodge City, is a 501c3 nonprofit organization created to address the housing needs in Dodge City. CHAD operates the abandoned housing program. The funding for this comes from the Moderate Income Housing Grant from the Kansas Housing Resource Corporation. CHAD partners with the Dodge City Community College Building Trades Program to create additional affordable quality housing units.
The college is really grateful to be a part of the project that we have with CHAD. Building this house gives our students hands-on, real-world learning experience for the entire year.
Working with CHAD is great, and it's a good program because we get to improve communities in areas in town that need help, like this one we're doing right now. It's gonna hopefully motivate people in the surrounding area to build better things as well and keep the area like not nicer and cleaner.
We're building a workforce at the same time that we're building the house. The city gets more affordable housing, moderate income housing, and we're addressing a big contractor and worker shortage by training our next generation. It's pretty rewarding to think about what we're actually doing.
These houses that we're building, they're in parts of town that may need some improvement. We're hoping to make the neighborhood look a lot better, feel a lot better, and hopefully other people will be motivated to fix up their houses after we're done here.
I'm not just learning my trade, I'm part of something bigger. I'm really proud of all the work we're doing here in Dodge City. It's just an awesome program.
This project isn't just about coming to school. That's what I love about it more than anything. It's not just going to school and learning something that I'm never going to use. It's something that's practical, and I'm proud of the work that we're doing on this house, and I'm proud of what I'm able to do for Dodge City.
So I feel like the students and hearing from the instructors can explain the program better than I ever could. So that's our abandoned housing program. We use it to build moderate income housing. We also will accept donations of housing and renovate them. All of these we turn around and then sell to moderate income families. We also have 2 programs that we created to help preserve our existing housing and help our low income homeowners. One of those is Paint Dodge, and I stole it from Brush Up Hutch from Hutchison. We apply for a grant from the community foundations every year, about $5,000 a year, and that funds this program. And it is for low-income homeowners to paint the exterior of their homes. So it helps the homeowners get out of, when they're out of compliance with city code, to paint their homes. We provide the paint and all the materials. If the homeowner is elderly or disabled, we've been able to find volunteers to paint homes for them. We partner with Sherwin-Williams and they give us a discount on the paint. Another program we have is the Community Home Renovation Program. And this was started with a $25,000 grant from the Black Hills Foundation. We've been lucky enough that we found other grants and businesses to supplement this. And then the CHAD, the nonprofit, puts money into this program every year. And it provides up to $5,000 in emergency home repair for low-income homeowners. You have to be low income, own your home, and it has to be the only home that you own. We've done everything from help replacing roofs to replacing broken windows, installing ramps, anything that you can consider emergency need. The nice thing about these 2 programs is there's no state or federal money tied to it. It's all local money. So, and we keep it that way because we were able to make all the rules and regulations where it really is emergency home repair. So if there's an emergency, you fill out a 1-page application, we approve it in-house, and we can get a contractor there to make the emergency repair that day sometimes. So it's really easy to use, and we like to keep it that way. The information for these programs, both the Paint Dodge and the CHRP, are on our website, as well as information about the RHID. We also promote the weatherization program through the state, and USDA has an emergency home grant program that we promote as well. So I think that's all I have. I'm going to turn it over to Carolyn, and then I'm happy to take any questions you may have.
Okay, hello. I thought I would just do some storytelling about the project that we're currently engaged in, maybe with a little bit of background of what led us to this point. We, like I said at the end, or was said in the introduction, we first started focusing on housing when the organization was just begun in 2011. And so we've kind of gone through several, I guess, experimental stages. We tried doing some renovations. We have given some incentives to individuals to build their own houses, and each of those has some relevance, but it really didn't gain the kind of traction we were hoping for a lot of replicability. Where we have kind of found, I think, our place in this is by being a developer when there really isn't economic incentive for a private developer to do so. We're really being the developer as Stafford County Economic Development. We started with a house, a duplex in 2013. We've developed a handful of other rental properties, but where we really dug in was within the last couple of years. And I think we initially thought that, the type of moderate income housing that seems to be gaining traction in a lot of other parts of the state would work in our area too. We needed moderate income workforce housing, but after we really look at this a lot more in depth, we realized that that's not affordable for the kinds of workers we have. So what people are used to in Stafford County, I guess I maybe should step back a bit to this slide, but really looking at what we have as housing. And what people are used to, we've got average age of house in Stafford County is 87 years old. That's the average. So yeah, we have less than, in the last 20 years, an average of 13.9 houses have been torn down each year, with only 2.6 being built. So we need, renovation isn't going to get us to where we need to be. We're not even keeping up by trying to, just focus on existing stock. A lot of it's not worth fixing up. And it's low value as a result. Sometimes I think people like to brag about the idea that rural America is affordable to live in, but it's kind of a big element of why it's affordable is so that we don't actually have the same type of housing at our disposal. So we don't have enough inventory to accommodate existing needs, let alone growth. And rentals in particular, only 20% of our housing is in rental. It's kind of hard to measure because a lot of that rental housing wasn't actually built as such. It's just older housing that people have found a reason to want to use as a rental property, but we estimate about 20%. And so, as a lot of you know, that will lag significantly state and national averages, which are more like a third of the housing inventory. So we're really trying to build others. But coming back to, is that affordable here? Construction costs exceed affordability. That's why we haven't had very much construction. So a chance encounter that I had with a professor at the College of Architecture at Kansas State University. His name's Michael Gibson, and he leads a studio that he calls Net Positive Studio. They've been focusing on affordable housing with a real eye toward energy efficiency. And when I explained to him that we're trying to kind of crack the nut on that in rural areas, he was open to taking a look at that. And I'm really thankful for that chance encounter, because I don't think there can be as much interest sometimes in the very rural areas of the state, and he was open to that. So that led to their class developing, okay, so I guess I'm kind of skipping here too, but this, I use this example of kind of coming back to what I think a lot of people think is going to be, so when I say a lot of people, even like our own civic leaders in our county, they're expecting us to build something like this. It's not affordable. That house was built in Stafford County in 2016. At the time, it cost $160,000 to build, and now it would be over $250,000. And for the kind of incomes that we have, the median family income is about $66,000. We have a lot of people that are, making $20 an hour. And I know that by some measures, putting a third of your income into housing is affordable. But on our website, if you're really interested in our analysis of it, we've kind of broken that down. What does a budget really look like for a single person making $50,000, for a family making $66,000, for a family making $100,000, for a family making $125,000? And when you really look at all the reasonable expenses, you can't do public transportation. You got to have a car living in the areas that we do. I really think that this is why when we had incentives for people to build houses like this, they didn't take off. So I really approached Michael Gibson's class with the challenge. You got to find a way to build housing that at least approximates $100,000. Where are what that housing cost is. We can't be building housing that costs twice as much or more. People just can't afford it that we have here. So they took on that challenge, and this is what they built. It was a design build class. It actually, since it hit during COVID, it took a couple of years to actually carry out, but they did it. And it's very simple. It's just very simple. It does not have an attached garage, and it's on slab. And those are the two probably most significant trade-offs in terms of construction costs. But it's on the inside. I think I probably should have put some pictures of what it looks like on the inside. Almost everyone will say, oh, this isn't what we expected. It's a lot more spacious, or it's a lot more comfortable than I would have guessed. And that was kind of deliberate. They really felt like that a well-designed house put more into the livability of it, the way that a family interacts, than it does on curb appeal. And so we carried that out as a prototype and then kind of pondered whether we could get that built, you know, whether we could replicate it in Stafford County. And so we were lucky to get funding through KHRC through the home program. That, I will point out, takes the step of becoming a community housing development organization. We chose to do that because we didn't have any strong activity by an existing CHODO in our county. It's not to disparage any of the CHODOs that cover our region. We're a small county. It's not always practical for them to actively develop housing in our exact location, and that was the case. We had never had housing actually developed by a CHODO, so we decided it was time for us to jump into that. So we presented this idea as a house that could be built on infill lots, so that not only reduced the cost of just site development, but it also allowed us to truly develop a county-wide program, because it's a scattered site project, but we are halfway through our project to build 9 of these of the same design, giving us 10 houses in the county. And then, so very much what made this feasible, very much a cost, you know, an eye toward a low price point in the first place. Like I said, it's no basement, no garage. I think that part of the evolution of learning for us, even through this academic project, was that conventional building methods are not always bad. You know, like our Net Positive Studio focused on doing structural insulated panels. There were reasons that it worked for them for doing the academic project. They were able to build those in a workshop in Manhattan and bring them here. But in the end, they're not something that necessarily makes this less expensive. You get a good contractor that knows what they're doing and can frame a house, and it really isn't an impractical way to go. So I just throw that out there. There's been different things that I've read on different methods like 3D printing or modular. We looked into that at different times. Our own experience, for what it's worth, is just the idea of getting a good contractor to stick with the basics and carry it out is not a bad way to go. Kind of coming back to the idea that we're just trying to keep the costs low in the first place, finding a way to be sales tax exempt can be beneficial. It was one of the reasons I asked the question I did earlier in the presentation, but in a couple cases, it's not been the case in each of our projects in economic development. We have had a couple where it aligned to very much be a co-developer with the county. And so the county, when they were actively a part of paying contractors, qualified for a sales tax exemption on the construction itself. And that helped buy the cost of the project too. We've used infill lots. We have a land bank in 2 of the towns in Stafford County, and those have been a part of acquiring properties at tax sale or otherwise dilapidated or properties, and they've been good to be active in donating to us. In other cases, we just had concerned citizens. In one town, in the town of Hudson, it was a group of 5 or 6 people that went together and purchased a low value house and tore it down. And then in another town, there was an individual that just was willing to donate lots that he owned adjacent to his own home. And so that's that kind of grassroots part of how we're trying to, again, keep the costs down and just carry out a project in multiple sites. By being a CHODO for the properties that we own and rent to the purposes of a CHODO and its affordable housing goals, we don't have to pay property taxes on those. So that does make a difference. It makes a big difference in how we can cash flow a project and it wouldn't be obviously compatible with an RHID, but in the cases where we're trying to expand rental housing, which we know again is in demand. In fact, our little project of 9 houses, we haven't even advertised it. We have a waiting list of 24 right now. So we know that rental housing is needed, and we can use that CHODO strategy to kind of help, again, cash flow our project. Finding the right contractor. The one that for us seemed to be able to check all the boxes of keeping this affordable, he's self-performing a lot of the work. So we don't have a separate concrete contractor and you know, they're not pre-buying or buying pre-made trusses, doing all that on site. And to put it into perspective, that house, as we had it bid out, we had 3 bids. We went to 20 different contractors trying to get interest, and it wasn't as easy to get interest. One of them flat out told us we'd rather build one house worth $350,000 than 3 houses worth 110. So now that we've got the contractor, we're doing everything we can to keep him interested in our project. But 2 bids that did come in other than his were one for $220,000 per house and $187 per house. And the bid that we've gone with was $127 per house. And we have some other costs associated with it, but it's about $135,000 for this round of houses on slab is kind of what we're estimating. So I don't remember, I guess that's it. We think that we can maybe replicate this in another phase with some modifications. We're looking at how we might be able to take that exact same house and put it on a basement and have maybe some wider appeal to those who say they really want more space than that or whatever. We think we can get that built for about 190 right now, even considering all the costs of material increases and everything, which may be pushing the boundary, but again, we know there's demand at the lower prices. It's the harder part is figuring out how to build. I don't know, more what people maybe conventionally expect in new construction, but just really isn't finding traction here.
Thank you for that example for both you and Molly. And wow, you have 9 and a 24 wait list. So do you see additional projects coming, or does that kind of exhaust your area you have?
Yeah, no, we're hoping that, well, in fact, our county has already agreed to putting money into our organization for housing for the next 3 years. And our hope is to now go to each of the cities and ask them for a 6-year contribution that would give us the base for another MIH application and really building out this program for another 10 to 15 houses beyond what we're already doing.
So the increased funding to MIH is definitely good timing.
It is.
And everybody should be on that webinar on Monday to hear more about that. So thank you again so much. Okay, Carolyn, real quick, are homes for sale or rent or both?
The ones that we've just done, because it's funded through, it's the home program and Federal Home Loan Bank's affordable housing program. They both carry substantial restrictions on how we can rent them. We anticipate owning them for 20 years. So it's not that you can't sell a house. My understanding is, though, that you have to find buyers that fit those income requirements, and it's very unlikely that you're going to find someone that is both going to qualify for a mortgage to purchase a new home and fits the low income categories. Maybe we're going to come closer to that with houses that are of lower cost in the first place, but we're counting on owning those for 20 years. Now, in the next phase of things where we might be able to tap into less restricted funding, absolutely, we're interested in opening up more of this to owner occupied.
So depending on the funding stream. Definitely. Cool. Okay, thank you for that. Tylen, we did have a question earlier for you in reference to about the number of projects or communities you're having reach out to you. Has that changed much, and what are you seeing?
So we're right now we have 9 projects lined up. We have about 7 or 8 that we're still in talks with, and that's adding 2 to 3 a month right now. So like for instance, Molly's sitting there. We're talking to her about some stuff out there as well. I actually just sent a direct statement to Carolyn because that was awesome. Because we do everything from duplexes all the way up to apartment complexes. And so there's a lot of things we can do on a smaller scale that actually bring solutions to even the small areas. And so we expect that to start blowing up. Like right now we're talking to the bigger areas that are really active. Like Molly's super active. They know what they're doing on the economic development side. For the folks who haven't been doing it for a long time or haven't got out there, we're starting to see that explode. So yes, that's starting to go up for us, and we don't expect it to slow down at all.
Thank you for that. Yeah, definitely. A lot of our small areas like Stafford County and our small communities have to definitely get creative on how to make a project work, and a lot of partners at the table. I think that's really what we've heard echoed quite a bit. Everybody at the table and just being open-minded to how to make a project work and finding all those funding options that are out there. So it sounds like there's a lot of tools. So thank you all very much. And with that, that'll wrap up our session 3 for our Grassroots Economic Development 201. So thank you to everybody that was able to join us. Next Thursday, we're going to talk a lot about marketing and selling your community and what communities can be doing creatively to help, just really build on that vision and the energy around rural communities. So we will look forward to that next week, and hope everybody has a good afternoon. And thanks again to all of our presenters. Bye.